Hi to all. So in this lecture, we're going to talk about these concepts: payback period, discounted payback period. So these are concepts related to what is known as capital budgeting. So capital budgeting is just the process through which a firm or a company evaluates an investment or evaluates which of two investments is more convenient. Whenever there are capital constraints, or the firm needs to decide between two projects based on some metrics, and this is one of these metrics. So basically, let's start with a payback period. Payback period is one of the simpler methods because it just accounts for the question: how fast is the company going to get its original or its initial investment back? So let's assume that we have this company that just acquired or is evaluating to acquire a manufacturing plant. This manufacturing plant, and let's assume it has a cost of $1,450,000. So how fast is the firm going to recover this initial investment given the cash flows that the firm will generate from the activities that are going to be carried using this manufacturing plant, through this manufacturing plant, right? So this is quite simple, and I want to keep it in this way, and then we will move forward to discounted payback period. So the first thing, every time you see this year 0, just keep in mind this only means today. So we are just facing the possibility of investment of this amount today, and then we're going to receive or start receiving these cash flows starting next year, year number 2, year number 3, year number 4. So today, if we want to look at something that we refer to as cumulative cash flow, that is just the overall sum of all of the cash flows that are resulting from this new activity that the company is evaluating. So at year number 0, the cumulative is just simply going to be exactly the same as the initial investment. So we have $1,450,000. Now what happens is that once the manufacturing plant starts operations, then when we reach year number 1, we just have this positive cash flow, or in other words, revenues that the firm is receiving from this manufacturing plant. So initially, we had invested $1,450,000. When we reach year number 1, or the end of 1 year, we're just going to recover these $500,000, and we will still have $950,000, which are pending to be recovered from our initial investment. Okay, if you want to put it in simpler ways, just think about you starting your some kind of a small business, and you're buying this computer, and that computer will allow you to make some kind of activity which will generate some income for you, personal income for you. So you will usually and intuitively think about how long will it take me to recover the investment that I had to make or to take to acquire this equipment or this computer. So this is what we intuitively think about when we decide whether or not it is a good idea to purchase one equipment and to pursue some kind of activity. So this, in a more formal setting, is what companies do when they're evaluating the payback period, just that in a more formal way. So we still have $950,000 which are pending to be recovered. Now we move to the second year, and because the second year everything is more tuned up, so things are running more smoothly, so they're able to generate a higher income, and at least in this example, every year they're generating higher revenues. When we reach the second year, then we are recovering $700,000, and so we will still have pending $250,000. Now, if we move forward to the third year, now we will know that this, instead of negative, becomes positive, and we would have a cash flow, a cumulative cash flow of 550,000. Okay? This just simply means that when you reach the end of the third year, you already have in your pockets $550,000. So in the year number 0, or in other words today, you have to take out of your pocket $1,450,000. But when you reach the end of the third year, you will have now in your pocket, in the firm's pocket, in the firm's bank account, $550,000 positive. So you recovered your initial investment, and now you have a surplus of $550,000. When you reach this point, now you don't need to continue doing this, but you need to acknowledge that it took you 1 year, 2 years, and we cannot say it took you 3 years. It took you 2 years and some portion of the third year to recover your investment, because during the third year you recovered, or you received revenues in an amount of 800,000, but there were only 250,000 pending to recover the initial investment. So at what point of the third year did you finally complete your initial investment? So basically, if you just divide this $250,000 by this $800,000, which you received in the third year, then you will notice a portion of 0.3125. So this means that it took you 2 years and almost a third, 0.3125 of the third year to recover your investment. So the payback period is simply 2.3125, and we're done. So that is payback period. Now, this is ignoring one thing we have been learning about, and that is time value of money, because it is just giving the same weight, the exact same weight, to all of the cash flows, regardless of the point in time in which the cash flow is occurring. And that is a mistake. Or in other words, you can do your estimation in this way, but it's not going to be accurate, because it is not the same to receive $500,000 in 1 year than to receive them in 3 years or in 4 years. So we need to acknowledge for the time value of money. So this is how we get to discounted payback period, and I'm going to give you a hint, which is going to make things way easier. We're just going to follow the exact same procedure that we used for payback period. But before we start the exercise, we're going to adjust all of these numbers, and we're going to take them to present value. After we do that, then we are going to do exactly the same, and we are going to get, instead of a payback period, the discounted payback period. So let's write these numbers in blue, and we are going to have, instead of cash flows, we're going to have discounted cash flows. Okay, and we're going to have exactly the same year 0, year 1, 2, 3, and 4. In the payback period, we only got to the third year. So we only needed 2 and 0.31 years. But we are not sure, once we get this to discounted to present value, if in the discounted payback period we are going to need more than 2 years, maybe 3 years, we're not sure. So let's just convert all of these values to present value first, okay? So how do we convert all of these values to present value? I'm not going to do the calculations here. I'm just going to plug the number directly. But I'm going to just write one example, which is going to be the 500,000. So the 500,000, let's say we're converting. We have seen this. It is very simple. It's just we just do 500,000. We divide it by 1.5 point, or 1 plus the discount rate, which is 0.5. In this case, n is just 1. If you were in the second year, so you were working with the 700,000, then you would need to raise it to the power of 2. But this is taking place in the first year. This is just to the power of 1. To 1. And so this number is going to be equal to 476, 190.48. Now, you are already experts in this, so you're going to do the exact same thing for all of these years, and now we're going to plug here the discounted cash flows. Otherwise, I'm going to run out of space, so I'm not going to do the calculations for each one. So the first cash flow, it's occurring today. So if it's occurring today, you do not need to discount it. It is already in year 0. Even if you use the formula, then this n would be 0, and so you would cancel the denominator. So it is just 1,450, and that is it. Now, we want to know how fast we're going to recover this 1,450,000. Now, we already did the calculation for the 500,000 that we are receiving in the second year. So let's start plugging these values, and the first number is just going to be 476, 190.48. Now we have $700,000, and we're going to discount them. 700,000 divided by 1.05 to the power of 2. Once you do that, you're going to get 634,000 and 920.63. Okay? We do the same with the third year. So it would be, if you do the calculations, 800,000 divided by 1.05 to the power of 3. And then you would simply get 691,070 and 08. Finally, our last cash flow, which is 900,000. So the calculation would be 900,000 divided by 1.05 to the power of 4, and you would get 740,000. 432.23. Okay? So we just changed this series of cash flows into a series of discounted cash flows, right? Once we do this, once we have done this, then we can just do the exact same procedure that we did before, which is quite simple. So what are the cumulative cash flows here? So the first one is just going to be 1,450, and that's it. Now the second cash flow, once you add this initial investment to the discounted cash flow of year number 1. So in year number 1, the firm is receiving $500,000. But because we're discounting it, we're acknowledging that because we received these 500,000 in year number 1, they are worth less than just 500,000. So they are worth, their present value is 476,190. And so the cumulative cash flow is going to be 973,809.52. Now, once we add these 973,000 with the cash flow that we are receiving in year number 2. Now, this is no longer 700,000. This is the present value of the 700,000. So the present value of the 700,000 is this, 634,000. So when we have this, when we just sum the cumulative cash flow with the new cash flow that we are receiving in year number 2, after discounting it to present value, then we get that we still need 338,888.89 to recover our initial investment. And then in the third year, we are receiving 691,070. So once we reach that point, if we just wait until the end of the third year, our number would become positive, and we would have 352,181.19. So we acknowledge that by the end of the third year, we recovered our initial investment, and we got some extra cash already in our pockets or in the firm's pockets. So the recovery of our initial investment occurred again somewhere in the after the second year and before the third year. So somewhere in the third year. So we just need to divide, and we're going to do the exact same thing, divide what we have left. So I'm going to put a line here, or I'm going to write it here to make it simple. Right? So we're going to divide these 888.89 by the total cash flow of the third year, 691,070.08. So that is going to be equal to 0.490383. Okay? So, just summarizing this second version, or the version in which we're using the discounted cash flows, it took us just 1 year, then 2 years, and then we do not need the entire third year. We just need almost half of third year. So we need 2.49 years. So plus 2 years is equal to 2.49 years. And that is the discounted payback period. It is just, if you compare the both of them, this is 2.31, this is 2.49, which means that once you discount all these cash flows, you acknowledge that the longer or the further ahead in time you're receiving the cash flow, the lower the actual value of that cash flow is. So you're working here with present values, or the value today of each of those cash flows, rather than the value in the future, which is what we have here. So just summarizing or going over what we did, we have the payback period, which is simple. You just plot the cash flows here, and then you calculate the cumulative cash flow. Once you reach the point in which you have already recovered your initial investment, you just divide whatever is left by the cash flow of the following year, and you will find how much or what proportion of that year you need. So this is 2.31 years, and that is payback period. Discounted payback period, you can do exactly the same thing. The only difference is that you will firstly, before you do this, you will get the present value of these cash flows. You will just write them here. Once everything is written in present value, then you will do the exact same procedure, and you will get the discounted payback period, which in this case is 2.49 years. So I hope, given these two exercises, payback period and discounted payback period are two concepts that you become familiar with, and that any exercises related to any of these you're able to solve with ease. So thank you for your attention, and let's keep in touch.